Welcome to the Finance Offer podcast. In this episode, we are diving into the hidden mechanics of credit card cash advances and exactly how banks generate revenue from it. To understand how these systems really work behind the scenes, let's start with a scenario that happens to thousands of people every single day. Imagine it is late on a Friday evening. You're driving home from a long week at work, and your car suddenly stalls out at an intersection. You manage to get it to the side of the road and call a local tow truck. When the driver arrives, he hooks up your car, but he delivers a piece of bad news. His card reader is broken. He can only accept cash to release your vehicle at the repair shop. You check your wallet, you have zero cash. But you do have your credit card. You look across the street and see an ATM glowing in the window of a convenience store. You walk over, insert your credit card, type in your PIN, and withdraw $500. You pay the tow truck driver, get your car safely to the shop, and breathe a sigh of relief. You tell yourself you will just pay off that $500 when you get your paycheck next Tuesday. Feels like a clean, simple solution to a minor emergency. You used a piece of plastic at a machine exactly as you have done hundreds of times before. But you did not just make a simple withdrawal. By using a credit card at an ATM, you triggered a completely different financial contract. You stepped out of the standard retail credit system and walked blindly into one of the most aggressive debt traps in the modern banking industry. By the time you pay off that balance on Tuesday, you will owe significantly more than you borrowed. The bank has already started making money off your panic. By the end of this episode, you will understand the exact mathematical mechanics of a cash advance, why it is so profitable for card issuers, and why you should view your credit card PIN as a financial hazard. Let us look at why this specific topic matters so much right now. We live in an increasingly digital, cashless economy. Most of us rarely carry physical bills anymore. We tap our phones, we swipe our cards, and we pay our friends through apps. Because of this, when a situation actually requires physical cash, it is almost always an unexpected emergency. It is a moment of high friction, high stress, and limited options. This affects anyone who carries a credit card in their wallet. The cost of misunderstanding this system is an accelerated debt spiral that can catch you completely off guard. If you treat a cash advance the same way you treat buying groceries on your credit card, you will end up paying massive premiums for money you thought you were borrowing for free. The structural reason this confusion exists is entirely by design. The physical action of getting a cash advance looks and feels identical to using a debit card. You use the same plastic rectangle, you walk up to the same ATM, you press the same buttons. Your brain registers the action as a standard withdrawal, but the invisible rules governing that transaction are entirely different from standard credit card purchases. To understand how the banks capitalize on this, we need to break down the timeline of a cash advance step by step. First, let us look at the upfront fee. When you use your debit card at an out-of-network ATM, you expect a small surcharge, maybe $3 or $4. When you use your credit card, that machine fee still applies. But your credit card issuer immediately adds a secondary charge called a cash advance fee. This is not a flat $3 charge. It is almost always a percentage of the total amount you withdrew. A standard industry rate is 5% of the transaction, or $10, whichever is higher. So, when you withdrew that $500 to pay the tow truck, your bank instantly added $25 to your balance. Your $500 emergency actually cost you $525 before you even walked out of the convenience store. The bank justifies this fee as an origination cost. They treat your withdrawal not as a purchase, but as an instant, unsecured microloan. And they charge you a premium simply for the privilege of accessing it. Next, we have to look at the disappearing grace period. This is the most critical misunderstanding consumers have about credit cards. When you buy a laptop or pay for a dinner out using your credit card, the bank gives you a grace period. This is usually a window of 21 to 30 days. If you pay your statement balance in full before the due date, you pay zero interest on those purchases. You borrowed the bank's money for a month, entirely for free. Here's where it changes. With a cash advance, the grace period does not exist. It is completely erased from the equation. The exact second the ATM dispenser pushes those physical bills into your hand, the interest clock starts ticking. There is no 30-day buffer. Even if you pay the entire balance off 3 days later, as you plan to do on Tuesday, you are still going to be charged interest for those 3 days. The bank generates revenue from day one. Now, let us examine the specialized interest rate. You might know your credit card has an annual percentage rate, or APR, of perhaps 18 or 19% for normal purchases. But if you read the fine print of your cardholder agreement, you will find a secondary, much higher number labeled the cash advance APR. This specialized rate is typically exceptionally high, often hovering right around the legal limit, sometimes 29.99%. Why does the bank charge a massively inflated interest rate just because the money is in physical form? It comes down to risk assessment. When you buy groceries or a plane ticket on your credit card, the bank views you as a normal consumer managing your daily cash flow. But when you bypass retail stores and pull raw cash out of an ATM using a line of credit, the bank's algorithmic risk models flag you. The system assumes you are out of actual money. It assumes you are desperate. In the eyes of the bank, desperation equals a higher risk of default. To compensate for that perceived risk, they charge you an exorbitant premium. And finally, we have to talk about the payment allocation trap. This is how the debt spiral accelerates. Let us say you already had a balance of $1,000 on your credit card from normal retail purchases at that 19% interest rate. Now you add the $500 cash advance at 30% interest. When your monthly statement arrives, you decide to make a $200 payment. You might logically assume that your payment goes toward the most expensive debt first, knocking down that 30% cash advance. But that is not how the foundational math works in the bank's favor. Federal regulations require credit card companies to apply any amount paid over the minimum payment to the balance with the highest interest rate. However, the minimum payment itself is generally applied to the balance with the lowest interest rate. This means if your minimum payment is $50, that $50 pays down your cheaper, 19% retail debt. The bank allows your expensive 30% cash advance debt to sit there, untouched, compounding daily, generating maximum revenue for the issuer. Your cash advance balance acts like a parasite, clinging to your account and draining your funds much faster than your standard purchases. Understanding these mechanisms brings us to a deeper strategic insight about the financial system. Why does this system work the way it does? It works because of incentive alignment and asymmetric information. The bank fully understands the mathematical gravity of a cash advance. The consumer generally does not. The bank designs the interface to be frictionless. They mail you a PIN for your credit card. They make sure ATMs are on every corner. They remove every physical barrier between you and that cash. But behind that frictionless interface is a highly aggressive revenue model. Banks are willing to offer you cashback, travel points, and fraud protection on your normal purchases because those perks are subsidized by the margins they make on high-friction events. Late fees, balance transfers, and cash advances are the profit engines that power the rewards programs for everyone else. This reflects a broader financial pattern you will see repeatedly. The financialization of convenience always carries a hidden premium. Whenever a financial institution offers you a fast, easy shortcut out of a tight spot, you are paying a disproportionate tax for that convenience. The harder the money is to get in reality, the more expensive it is to borrow when a bank makes it look easy. Let us recap what we have covered today. You now understand that pulling cash from an ATM with a credit card is not a simple withdrawal. It is a specialized, front-loaded microloan designed to bypass the standard protections of retail credit. You know that the bank will hit you with an immediate percentage-based upfront fee. You know that the standard 30-day grace period does not apply, and the interest clock starts ticking the very second the cash leaves the machine. You understand that the interest rate on that cash will be significantly higher than your normal rate, and that the bank's payment allocation rules are designed to keep that high-interest debt on your balance sheet for as long as possible. With this structural clarity, you can now identify this trap in the real world. The next time you face a cash-only emergency, you will not view your credit card as a quick fix. You will view it as the absolute last resort. You will know to look for alternatives, whether that means using a debit card, transferring money between accounts, or calling a friend before you ever type a credit card PIN into a cash machine. You are now equipped to navigate this system without falling into the margin-generating traps designed by the issuers. If you found this breakdown helpful and want to continue learning how the financial system really works, please hit that subscribe button, give this video a like, and leave a comment below with a financial topic you want us to cover next. Thanks for watching the Finance Offer podcast, and we'll see you in the next episode.